Ghosh of State Bank of India, Chief Economist, the only man on the street to have, predicted a 50 basis point rate cut from the RBI. Mr. Ghosh, let me begin by congratulating you on getting that right and also on your appointment at, to the Prime Minister's Economic Advisory Council. But on your first take, the 50 basis point cut accompanied by the 100 basis point cut in the cash reserve ratio, what will that do for the economy?
Thank you, Ritu, for the comments. I think, Ritu, there are 2 points in the policy. It's very clear and unambiguous. There has been an unanticipated surprise, of course, in terms of the rate action. But on the rate action, I think it has been front-loaded clearly to aid an investment revival and to lower the cost of borrowings. The second point on the CRR cut, what is most important is that I think the CRR cut has been front-loaded in statement. And it is being cut in September, October, November, December. I think the important point during the CRR cut where the market actually is thinking about why there has been a CRR cut where the liquidity has been abundant. I think one of the primary reasons of CRR cut could be that it's having a significant impact on the money multiplier. And in an inflation targeting regime, the money supply growth is always endogenous. So if the base money growth is on the smaller side, a higher multiplier actually translates into a larger monetary base. So I think that is one of the thinking which has possibly gone into a CRR cut. And also the second factor is that the CRR cut will have an impact on the MCLR going forward, not now. And that will be actually in the busy season. So overall, while the front-loaded rate cut would now actually cajole the investors in terms of taking up activities they were thinking of not doing it because of the uncertainty. The action on the liquidity front and the CRR will actually make it happen in the second half when there is the busy season credit policy. So I think this is the overall line of thinking in the RBI, if I am correct, Anna.
Well, we take your point there. Neeraj Gambhir, the fact that the stance has been changed to neutral, how is the street reading this? How extended could the pause really be? And is that a bit of a dampener for the bond markets, even with the large rate cut and the CRR cut that we've got?
So the pause can be really extended. Very hard to put a number on it. We'll have to see how the data comes out, particularly on the growth side over the next 2 or 3 quarters. But I think at least 2 to 3 quarters will be on pause, given what Reserve Bank has done now. Market was actually expecting 225 basis point rate cuts between June and August. That has been delivered now, with the possibility of any further rate cuts in the near term over the next 6 months looking very low. Obviously, the longer end of the bond curve has not taken very positively to it. We are seeing yields go up. Initially, they came down, then they have gone up by roughly 4 or 5 basis points. But I think that's just an immediate reaction. On the contrary, we are also seeing a fairly significant reprice or yields moving down in the shorter end of the curve, both in government bonds as well as in CPs, CDs, and corporate bonds. Corporate bond yields are actually down by roughly anywhere between 10, 15 to 20 basis points across the curve. So I think the benefit is largely being seen currently in the shorter end of the curve, and the curve has steepened. And the benefit is being seen in the corporate spreads, which had widened initially, but now seem to be tightening a little bit.
All right. And Pranjal, your key takeaways and what is now your expectations in terms of this pause and what the terminal repo rate could be?
Yeah. Thank you. A couple of points. One is, I think this was a very clear case of front-loading, as Soumyakanti Ghosh pointed out. Steps that the RBI wanted to do, but didn't want to stagger it over a few months, rather wanted to do it all at once early on. So it's front-loading. Number two, it wanted to give a package. I think, it wants to give liquidity. It wants to lower the cost of funding, but in a way that NIMs are supported. And I think that's where even the CRR made an entry. The third point I would make is that I think we have to now think about what role the RBI wants to play in the state of the economy. And I think there's been a big change here. It's not just about cyclical growth, about trying to tackle growth today or inflation today, but I think they want to affect the medium-term growth of the economy, the potential, the structural growth of the economy. And I think things like cutting the CRR by 100 basis points at a time when it's not a crisis-like situation just basically, talks about that to me, that they want, credit growth to rise in a way that over time for multiple years, GDP growth in India is actually raised. In terms of where we go from here, look, my sense is a lot has been done so far. We were thinking terminal rates will be 5.25, but we were not expecting the CRR cut. So now that the CRR cut has come as well, our sense is that, maybe this is good where they are for now. I don't think there's much space to cut rates at this point of time. And I think it's fairly responsible of the governor to reiterate in the presser that, it's a neutral stance. Extra space for more monetary easing at this point of time is limited. Inflation in FY27 will be close to 4.5%. So maybe, giving the signal very loud and clear that at least in this calendar year, there'll be no more rate cuts or liquidity easing.
Yeah, in fact, the Reserve Bank of India governor put it in so many words when he said the MPC finds no space right now to act in the current environment, and hence the change in stance to neutral. But Madhavi, what is your sense on this pause and the terminal rates? And like Pranjal pointed out, perhaps the focus is very much centered on growth now. I think the governor at some point even said 6.5% is good, but the aspiration is 8%. And therefore this, cut in CRR at a time when liquidity is in surplus.
Hi, Ritu. So I think the front loading of rate cuts, I think is a very smart move by the policymakers when they're very certain as to where the macro dynamics are headed, at least in the near term. We may see inflation even going below 3% in the coming months or so. So they're front loaded at a time when there's a global calm. They wouldn't want to really take action at a time when maybe there could be a global chaos, probably 3 or 4 months down the line, where there could be more noise with regard to trade dynamics not really finding a new equilibrium. So I think the decoupling that emerging markets are enjoying from developed markets has been very well optimized by the Reserve Bank of India, especially when they have a clarity with regard to where the macro dynamics are headed, which are still growth supported, supported of a much lower monetary policy rate. Most of us were expecting the policy rates to go below 5.5% in the terminal rate. Our own expectation also was a 5.25. So I think it's a very commendable thing that they have front-loaded at a time when there's supposedly a global calm and supposedly a decoupling on emerging market fronts as far as their policy assessment is concerned, and as far as even their risk-free rates are concerned. Now, secondly, coming on the liquidity aspect of it, I think we've been reiterating in our notes and to our clients as well that we were never of the view that there was an excess liquidity fraud that RBI is infusing in the economy. Insofar, they've done more than 9 lakh crore of primary infusion. Our own math suggests that even if they had to reach a 1.5 or even a 1% of NDTL soft liquidity target that they have, sort of indicated in their pressers last time, they still would have to infuse at least 2.5 to 3 lakh crore of new liquidity from the RBI's own book. Of which, I think a large part would now come from CRR. We were expecting more OMOs, more towards second half of the year. Now that is sort of taken away. But, if you look at the past transmission cycles as well, be it the Rajan era or Patel era or even pre-2019 rate cuts that we saw, all of them actually saw liquidity surplus being towards a 2% of NDTL or more by the end of the cycle. So there was, I think this time around the surplus is still much lesser than the past cycle. They have obviously front-loaded that, but one has to see that, if you look at the still tepid growth in base money, which again is emanating from the fact that RBI's own balance sheet actually over the last 3 years has barely grown by less than 6-7%, also implies that they had a lot of role to do in terms of expanding their own balance sheet by doing more primary infusion in the form of OMOs, CRR cuts or FX swaps or whatever that takes to basically increase their own balance sheet to ensure that there's a percolation down the base money route. And this is what Soumya was also mentioning, that the role of central bank in infusing primary liquidity was not yet over, and we were expecting them to do more on the infusion bit apart from cutting rates. It was more towards through the end of the year, but I'm very happy that they've actually been much more front-loaded in terms of, using current global calm as an opportunity to actually deliver.
Well, yes, that, 2.5 lakh crore liquidity bazooka from the CRR cut and coupled with the dividend, I think the target of 1% of NDTL surplus liquidity will be more than adequately met. But Rajiv, on the bond market side, we went into this policy expecting a 25 basis point rate cut and accommodative stance. It's turned out quite the opposite. Where do you see the 10-year settling?
Yeah, I think it's an interesting question. In fact, from bond markets perspective, you got a policy repo cut which was higher than what the market had priced in, and you had a 100 basis CRR cut as well, which was unanticipated. But I think the big change has been, or the dampener, if I may were to use that word today, it has been on the stance change, wherein they have gone back to neutral. And effectively, even with the FY26 CPI projection being brought down by 30 basis points, the market possibly could have been looking at the terminal rate being even lower than 5.5. I think that's possibly the dampener from a market perspective, and which is what is getting reflected, at this point on the long end of the curve. But in terms of where you expect the 10-year to eventually settle, I think what needs to, even with a 50 basis rate action, and given that the liquidity surplus is likely to sustain and will be aided by the additional, the CRR reductions that will percolate down to the system. So the effective funding rate will be much lower than 5.5. So you're looking at the effective rate around 5.25 for the foreseeable future. So in that situation, given that we don't really expect any immediate reversal of the policy trajectory, you could possibly see the 10-year benchmark trading lower over the next few months. Possibly closer to 6 is clearly possible in this cycle, given that we really see that surplus liquidity environment to sustain, which basically would be reflected in the effective overnight rates, which will stay much lower than the policy rate.
Okay, well, I'm back from the press conference, so if I can squeeze in a couple of questions. Neeraj, do you agree with Rajiv's interpretation? I directly asked the governor, do you want to keep the call rate at the repo rate? He said, we have not made up our mind. So I don't know what you took away from that. Do you expect the call rate to remain at 5.25? And again, the same question that Ritu asked Rajiv. Is there still a bond rally left, or is it over?
So there are two parts to this. One is the intent and second is the mechanics. Let me first answer the mechanics. As long as the system is in surplus and Reserve Bank is not taking out that surplus through, VRRs at the policy rate, you will see call market rates and overnight rates settle towards the STF rate, because that's the only place where banks can park the liquidity. So for Reserve Bank to bring the overnight rate from 5.25 to 5.5, they will have to actively intervene through the VRRs in the system at the policy rate or near the policy rate. So I think that's the decision that they need to take. My guess is that they might not take the decision early on as yet. They might allow this situation to persist so that there is faster transmission. That's what they seem to be wanting. And if the overnight rates stay close to 5.25, then the transmission obviously will be far faster. So I think once they get a sense that transmission is done and the liquidity in the system is doing the job that it is supposed to do, maybe they can steadily bring it back towards the repo rate. But that remains to be seen. So I think it'll evolve over the next, I would say, month or 2 months.
Okay. Well, I got a sense that we have to wait and see. There may be a possibility they will do the repo auctions. He didn't quite say no or yes to it. But again, bond rally, you think it is over? We are at the possibly the lowest point of the yields because it looks like an extended pause. In fact, do you expect another cut at all?
So firstly, I don't expect another cut as yet. I think for the foreseeable future, we'll have to see how the growth pans out. Second, is the bond market rally over? I don't think so. The size of liquidity infusion that is being done, the intent and the front loading of the rate cuts, I think provides a lot of space for the bond market rally to continue. It may not be seen in the 10-year benchmark because all of us tend to focus a lot more on 10-year benchmark. But I think you will see, as I mentioned earlier, that there is steepening of the yield curve that has happened, which means that the front end of the curve has performed a lot better. We are already seeing CP/CD yields come down quite dramatically, and they could potentially come down some bit more. And the corporate bond spreads can actually tighten up from here as well, because they had widened as the government bond yields were actually coming down. So I don't think that if you're seen as a whole, the bond market sort of play is yet done. I think it'll happen over the next 3 or 4 months.
Oh, okay. I wanted to ask Sakshi and Madhavi. Sakshi, first you and then Madhavi. Have you all changed any forecast in terms of where you see the terminal repo rate now? and growth forecast for the year. Sakshi? Sorry, Madhavi, sorry.
Is it for Pranjal or for me? Okay, so as of
I'm
now...
sorry, I meant Madhavi and then Pranjal. Yeah.
Latha, as of now, I mean, I think given the fact that they have front-loaded their rate cut and they've given a sense that they would wait and watch, near term, the data is going to be supportive for, comfortable policy. I don't think near term we are looking at any policy action from the RBI. I think it will also be a function of how the global dynamics play out, because that will be, again, a very important factor in their own reaction function as we go ahead. Near term, I think we will also wait and watch. Our terminal rate otherwise was at 5.25. I think as of now, I'll still wait and watch, because I think they have delivered a lot in the immediate run. And I also believe they would want to wait and watch and see how the transmission really plays out for them. Anyway, the big liquidity bump up is going to come from the Reserve Bank only from September. But before that also, because of the RBI dividend, we'll have ample liquidity in the system. So through the year, we are very comfortable on liquidity, maybe some drying of liquidity towards the end of the year. But generally, we will end the year at around 1.2, 1.3% of NDTL, which is more than the RBI soft target as of now. So I think near term, we'll wait and watch and see. But as of now, I don't think that there will be any rate cut, at least in the next 6 months or so. And plus, a lot will happen globally. I think gradually markets are shifting their call on the Fed rate cut as well. We don't know how China's response would be after the 3-month moratorium with the US would end on the trade front. So a lot will also be playing a part. And plus the global bond rout, which is happening at a very rapid pace. So we'll have to see how that eventually transmits to our economy. As of now, I think emerging market, as I was mentioning, are in a very calm state. So I would just wait and watch rather than pushing for a further rate cut immediately.
Okay. No, I want to know actually whether because of the extraordinary loose policy today, CRR cut and more than expected repo cut, Pranjal, changing any growth forecasts?
Latha, there have been 3 positive surprises on the growth front lately. We've all spoken about weak growth, but there's been positive surprises. One, the reciprocal tariff, at least temporarily was reduced from 26 to 10%. Second, inflation suddenly started falling like a brick, which I think has improved real purchasing power for mass consumption. And third, that liquidity is a lot more looser than anybody had predicted, for the foreseeable future. I think all of this is very positive for growth. All of us who were worrying that growth could be sub 6%, I think that's now behind us. I think growth could be anywhere between 6 to 6.5%. 6.5% for me is potential growth. So, RBI's forecast at 6.5 seems to be, all right at this point of time. So I'm not really worried about growth right now. I'm not worried about inflation too this year. I think, in fact, inflation will be more like 3%, much lower than the 3.7% that the RBI has forecasted. But my worry about inflation is just in the way we have benefited this year from a high base, next year we will have to live with a low base. And just with the same monthly momentum next year, actually FY27 inflation can easily become 4.5%, again, something that the governor spoke about. So if you think about growth not being that bad and inflation being perhaps closer to 4 over a 2-year horizon and not much lower, I would say I think we are good right now where we are with the repo rate at 5.5%. I think for me, this is neutral. 4% inflation target plus 1.5% real neutral rate adds up to 5.5% repo rate. I think this is neutral, and RBI stance is also neutral. So I feel no real pressure for any changes at this point of time.
Okay. No, actually, I think the governor almost gave it away when he said, yeah, this year it is 3.5 or 3.7, but next year it is going above 4. So that almost seemed like a giveaway that, I cannot take this as the base and then go ahead and cut even more. Or at least that seemed to me. Neeraj, do you see loan growth increasing? At the moment, system loan growth is 9%, but with this gush, do we end the year with a much better loan growth? Your bank in particular, even.
Yeah, I don't think we are changing our forecast of loan growth as yet. I think loan growth is not just about the price at which money is available, but also the kind of other dynamics that are playing out, particularly the uncertainty on the global front, etc. So I think the capex, the private capex cycle and the demand from consumer side has many other variables to deal with before we can see a sustained uptick. But I would say that with the current action and the cumulative action that Reserve Bank has taken over the last few months, I think the monetary policy has done pretty much what it could for setting the stage for higher levels of loan growth, including the surprise CRR cut, because effectively what the CRR cut does is it allows the banks to create more money with the same amount of base money infusion by RBI. So I think the ground conditions have been set, but nothing much can be done about the global volatility and the overall economic conditions that are playing out. We will need some bit of settlement of that for people to gain the confidence and start thinking about private capex, etc. And that is going to be the key driver for growth.
Yeah, may I just hurry you? Is it fair to say that for the banking system, margins fall in the first half but rise in the second half because the CRR becomes effective?
Yeah, I mean, not just the CRR, but the transmission of rates into the liability side. I think the asset side will reprice first, and liabilities reprice with the lag. So I think that dynamic will play out.
Okay, all right. I'm being rushed. We have taken a lot of time. Thank you very much, Pranjul, Madhavi, Neeraj and Rajiv for being with us. Over to you, Ritu.
Well, thank you so much, Latha, for joining us there. And thank you for all of our guests. On that note, we're going to have to wrap up this discussion. Big policy, bigger takeaways and the guidance ahead as far as the non-policy measures are concerned. We'll continue to analyze them right here on CNBC TV 18. Don't go anywhere. We're back in a moment. But for now, we'll step into a short break.